So we have questions from viewers, sort of general questions, and I think we'll frame it that way for your response, Congressman, about what tax reform might look like and what you think is critical to be in a tax reform bill. This, of course, is something that the Trump administration, the President of the United States, ran on in his campaign last year, and of course this is part of the budgeting process.
Yeah, but I think also, to be fair, I think Hillary Clinton also wanted to have tax reform and reduce the rates. I don't think there's anybody out there that doesn't want to reduce the rates. We have the highest corporate rate in the world, and it's a problem. It needs to be fixed. You know, the question is how much you're going to lower it. You're going to lower it to 25%, to 20%. You know, what do you?
And that's part of the repatriation that we were discussing.
Well, right,
earlier.
that's part of it. Yeah, but Kevin Brady is the chairman of the Ways and Means Committee. And he's the one that's doing this in the House. So about a month ago, he called me up and he said, I wanted you to bring some Democrats over. I want to talk to you about tax reform, see if we can work together. So five of us went over there. And it kind of scared the hell out of me what he told us because, you know, he's fixated on doing a postcard. And that's a mistake, first of all. There's no need, I mean, so he wants to have 5 lines, you know, and all this stuff, which I don't really have a problem with, but this doesn't solve anything. But we got into the meat of what they were trying to do. One of the major parts of their proposal is to eliminate the deduction for interest expense on your business. So if you're a farmer and the interest that you pay on your farm, you wouldn't be able to deduct it. Or if you're a small business, the interest you pay, you wouldn't be able to deduct. What they're going to give you in exchange for that is that you can 100% expense any asset that you buy in the year you buy it, with no limitation. So I said to him, I said, do you mean to tell me that if you could buy a $100 million apartment building and write it all off in 1 year? And he said, yes. And I said, well, are you going to keep the passive loss rules? And he didn't really even know what I was talking about. So, you know, I don't know. This is, you know, I think we need to lower the rates. I think we need to simplify the system. But I think getting rid of the interest deduction is one of the dumbest ideas that I've ever heard. And the whole thing is kind of hung up on that. And having 100% expensing gets people in trouble. And I'm a CPA. I know how this works. And part of the farm crisis that we had in the 80s was caused because of people overusing the tax system. And, you know, they would come into my office. We had investment tax credit. You remember that? You're old enough to remember.
I am indeed.
Right. So
I remember looking at the Section 1245 recapture provisions.
Right. Well, you couldn't tell anybody that. See, but so they'd come in my office. They'd say, "Okay, here's what I made." They said, "How much equipment do I have to buy so I don't pay any tax?" So I'd figure it out, you know, and they had to be new. So they'd go in and they'd buy equipment. Some of it they needed, some of it they didn't, but they didn't want to pay any tax. And then, you know, they wrote off, they got bonus depreciation, all this stuff, they wrote everything off. And then when they got in trouble, they had to pay all that stuff back, and they didn't have any money to pay it back with. That was part of the farm crisis. So now, go up to now the current time, we had 179 depreciation, what they raised to $500,000. You had bonus depreciation, which you could write off without any limitation. And so in those years, in 29, 10, 11, when people made all that money, you know, good years, they went in and bought a completely new line of equipment, farmers, and wrote it all off. Now they have no basis. Some of it they've borrowed money on, and now if they sell it, they're going to get killed tax-wise. Same thing that happened back 30 years ago, you know. So I think, you know, I think it's a $250,000 179 is plenty, you know, and these other things that they've put out there, I just think are going to get people in trouble. So I'm for tax reform. I'm for lowering rates. I'm for simplifying things, but I'm not for going off on some ideological binge, which some people want to do.
Well, and so if I were to describe your approach, then it would be that we might be better off with a more modest approach to,
Yeah,
to tax reform.
and we can't, it's got to be paid for. You can't, part of the issue, what they're doing is they're going to use dynamic scoring. And what they were saying was, if you allow 100% expensing, it's going to cause an economic boom. And so therefore, the tax cuts pay for themselves because of this boom that's going to be caused because we got 100% expensing. Well, nobody knows if that's true or not. It depends on what else is going on in the context. So I'm not totally against dynamic scoring, but I think you have to be cautious because you could blow up the whole budget situation. I was there in 1978 when Al Quie got elected, and I was on the tax committee, and I remember sitting in the room with Nick Coleman and McCutcheon and Martin Sabo and Harry Sieben and those guys when we put that tax bill together. And now, if you remember what happened, we had 7 special sessions to try to pull that budget back together because we overdid it. So you got to be careful. Yeah.